So let us start today with question number 6. Question number 6. Maruti Agencies has received an order from a valuable client for supplying 3 lakh pieces of a component at rupees 550 per unit at a uniform rate of 25,000 units per month. So the quantity supplied is fixed. Okay. So 25,000 per month we are going to supply, and total pieces will be 3 lakhs. So that comes to the entire period of 12 months. So in a year, we are going to supply 3 lakh pieces, and every month we are going to supply 25,000 units per month. Variable manufacturing cost amounts to 404.70 per unit, of which direct materials is 355 per unit. Production overheads, fixed production overheads amount to 30 lakhs per annum, excluding depreciation. So depreciation is to be considered separately. There is a penalty or a reward clause of 30 rupees per unit for supplying less or more than 25,000 units per month. So penalty for less supply, reward for more supply. So if you are supplying less than 25,000, there is a penalty to the extent of 30 rupees per unit. And if you are supplying more than 25,000 per unit, there is a reward, which is 30 rupees per unit. To adhere to the schedule of supply, the company procured a machine worth rupees 14.20 lakhs, which will wear out by the end of the year and will fetch 3.55 lakhs at the year end. So that is a salvage value. After this supply of machine, the supplier offers another advanced machine, which will cost 10.65 lakhs, will wear out by the year end and not have any resale value. So the first case what we are having is, we are having a machine having a value of 14.2 lakhs and scrap value of 3.55 lakhs. In the second case, we are purchasing another machine where the machine will cost 10.65 lakhs and will have no resale value, not have any resale value. Okay. Now, what they are saying is, if the advanced machine is purchased immediately, the purchaser will extend the earlier machine supplied at the price of the new machine. Fixed cost of maintaining the advanced machine will increase by 14,200 per month. So this is the additional fixed cost for the whole year. While the old machine had the capacity to complete the production in 1 year, the new machine can complete the entire job. New machine can complete the entire job in 10 months. So 2 months savings will be there to the extent of overheads. The new machine will have material wastage of 0.5%. So material wastage will be there in the new machine. Assume uniform production throughout the year for both the machines. Use the incremental cost or revenue approach. Decide whether company should opt for the advanced machine or not. So a typical examination question, very small question, but it's important because we have to know how to solve. Now, first of all, we'll have to calculate the depreciation. Incremental cost or revenue means that we have to see what is the difference between the old machine and the new machine. So suppose I go for the old machine. For the old machine, the cost of the machine is 14.2 lakhs. Scrap value at the end of the year is 3.55 lakhs. So there will be a depreciation that we can calculate. So 14.2, calculate how much it is. 14.2 minus 3.55. How much will it be?
10.7.
10.65. Correct? 10.65 lakhs. Now 10.65 lakhs is the depreciation on the first machine, old machine, or you can say the first machine. Second machine, the cost is 10.65 lakhs, no scrap value. So the end of the year, it is discarded off like that only. So that means depreciation is 10.65 lakhs. So old machine also it is 10.65, new machine also is 10.65. Incremental cost is nil. Okay. Then I have salvage value. Salvage value, inflow of cash. Inflow of cash at the end of the year for the first machine is 3,55,000, and outflow of cash, inflow of cash for the second machine is nil. Okay, so like this, I will calculate the difference in the two machines and then find out what is the incremental cost or incremental revenue. And on that basis, I will see whether there is a gain or there is a net loss. Okay, so let us prepare a comparative statement. We'll have to prepare a comparative statement showing the comparative cost. So I will show old machine, advanced machine, and incremental. 3 columns, particulars in 3 columns. So prepare a statement like this. Statement showing comparative cost. I will not call it as old machine. I will call first machine. I will call advanced machine. And incremental. Okay. I start with the first one. Depreciation. In the first case, it is 14.2 minus 3.55. In the second case, it is 10.65 directly. So 10,65,000 here. 10,65,000 here also. There is no incremental cost. Okay. Second one. Salvage value at end. For the first machine, I'm getting 3,55,000. For the second machine, I'm not getting anything. So loss of revenue. How do I look at it? Loss of revenue. So 3,55,000 loss because of the new machine, because of the advanced machine. Loss of revenue. Third, we are told that the advanced machine will increase my fixed overheads by 14,200. So maintenance cost. Maintenance cost. Maintenance cost. 14,200 per month for 12 months. comes in the second column, that is advanced machine. So that is 1,70,400. Additional cost, so it will be again a loss, additional expenditure. But the new machine will result in wastage of raw materials to the extent of 0.5%. So wastage of raw materials. Wastage of raw materials. How to calculate? The raw materials cost is 355 per unit. Okay. So I require 3 lakh units. So 3 lakhs into 0.5% into 355 per unit. See how much it is? 3 lakhs into 0.5% into 355. 5,32,500. Additional cost again. So in bracket 5,32,500. What they have said is, if the new machine is purchased, okay, then we are able to complete the production, or the 3 lakh units can be done in 10 months. Entire job can be done in 10 months, which means that 3 lakh units I will be able to supply, produce and supply within a period of 10 months. So if that happens, see, look at the nature of the question now. What they have said is, they have not given us anything directly. They have told us indirectly that we can complete this in 10 months. Okay. So if I'm able to complete this in 10 months, what will be the impact of this? The impact of this will be that I will be savings 2 months. I will be having savings of 2 months. So if there is anything like variable cost, then I can show that. Variable overheads, for example. If there are any variable overheads, I can show that as a differential figure. Fine. But if there is no variable overheads, fixed overheads are there. But fixed overheads, whether I produce or I don't produce, the cost will be incurred only. There is no way that I cannot incur the cost. So what is the use of this particular statement? Let us see what is the use of this statement. Let us come back to the question. If I look at the question now, what do I find? I find that it is given to me that entire job can be done in 10 months, which means that 3 lakh units I can produce and sell in 10 months. So how many units am I producing per month? 30,000 units I'm producing per month. Correct? First machine is to produce how much? 25,000 units. 25,000 units. Now, since I'm producing 30,000 units per month, what will happen? I will be getting the reward. No? Reward will be given to me. Reward clause is there. 30 rupees per unit for supplying more units than 25,000 units. So how many units more I am supplying now? I am supplying 5,000 units more. Correct? 5,000 units more I am supplying for 2 months. For 10 months. For 10 months. So 30 rupees per unit into 5,000 units for 10 months. That will be the reward on purchasing the new machine. That is possible. So that is a benefit for them. Okay. So that I will take into consideration here. So right here, reward for supplying more. Reward for producing and supplying more. More than 25,000 units. So as I said, 5,000 units per month. I'm producing more for 10 months. Okay. So I get this at the rate of 30 rupees per month, 30 rupees per unit. So that comes to 15 lakhs. Now this 15 lakhs is a benefit. So it will be a positive figure. So now let us see what is the net benefit or loss. Take only the total of the last crop. Tell me what is the total amount. What is the final figure?
For 42, 600.
4,42,600.
600.
600 not possible because this is 4 plus
100.
100.
4 lakh.
100, sir. 100. 442, 100.
Okay. This is the net gain, no? It's a positive figure. So right now, since there is a net gain of rupees 4,42,100. The company should opt for the advanced machine. Okay. Okay. Let us take question number 7 now. Pigments Limited is a chemical factory producing joint products J, K, and L at a joint cost of rupees 9,60,000. So that is the cost of production. And remember that when we are having joint cost, we are joint products. We are having a joint cost, point of separation, that is separation point or split off point, and then we have separate cost. Okay. So the total joint cost of production is 9,60,000. Sales are given as 60,000 units of J at 5 rupees per unit, 20,000 units of K at 20 rupees per unit, and 40,000 units of L at 10 rupees per unit. The company seeks your advice regarding the following options available. First option. After the joint process, all of L can be further processed to make 36,000 units of M at an additional processing cost of 1,80,000. So you can call it as additional processing cost, or you can call it as separate cost for product L. Okay, so further processing cost is 1,80,000 for converting that L into M. Okay, and M can be sold at 18 rupees per unit. That is first option. Second option, the facilities used to convert L to M may be used to make 7,000 additional units of a new product A with a different raw material, and A can be made at an additional value variable manufacturing cost of 12 rupees per unit. So what they are saying, first option, the product L we can further process, have a new product M coming into existence with the same product L, which can be sold at 18 per unit. Second option, they are saying that whatever facilities, whatever equipment, machinery you are using for conversion of that L to M, instead of converting, we can produce some new product A. Okay, and this A can be made at a variable manufacturing cost of 12 rupees per unit, and we can sell that A at 30 rupees selling price. But there is a condition. If I'm going to produce the new product A with a variable manufacturing cost of 30 and sell it for 30 rupees, 12 and sell it for 30 rupees, the company will have to offer 1 unit of J as a free gift for each unit of A sold. So you have these offers now, buy one, get two free, something like that. So if you buy A, you get J free, complementary product. Okay. So that means A cannot be sold. Sorry, J cannot be sold. J will be given free of cost. So whatever cost we have incurred, we cannot recover that. These are the two options. Evaluate the proposals using the incremental cost approach. That means the difference in the two. Okay, I give you 5 minutes. First, you work it out. See if you can get the answer. If not, then we'll see how to solve. Try it out. Read the question. Read the two options properly. See what is the difference in the two, and see whether option A is giving us more returns, or option 1 is giving us more returns, or option 2 is giving us more returns. If you got the answer, tell me.
Sir, option A 1,08,000, option B 91,000 revenue.
Second option is correct. Our first option is not correct.
First option 2,08,000.
No. First option is less than 1 lakh. So second figure you're getting right, first figure you're not getting right. Let us see how to do. Statement of evaluation of two options. So here I have option 1. Here I have option 2. The revenue that I'm going to get from sale of product M. Option 1, I'm converting L into M. Okay. And M is being sold at 80 rupees per unit. The revenue from sale of product M. 36,000 units of M into selling price is 18 rupees per unit. Six lakh 48,000. revenue from sale of product A. That is a new product that I'm going to come out with. I will be manufacturing 7,000 units of A and selling these 7,000 units at a price of 30 rupees per unit. So 2,10,000 revenue. Now, less from this. If I'm producing M, I'm converting L into M. Understand? If I'm converting L into M, that is option 1. Then in that case, I will not be able to sell L. So there is loss of revenue from L, 40,000 at the rate of 10 rupees per unit. So less loss of revenue from L. I would have produced, if I had L as it is, I would have produced 40,000 units of L and sold it at 10 rupees per unit. So that comes to 4 lakhs. On the other hand, if I'm producing A, then there is loss of revenue from product J, because if I'm producing A, along with A, I'm giving J free of cost. Correct? So loss of revenue from J. How many units? 7,000 units of J. And what is the selling price of J that I'm not going to get? 5 rupees per unit. So 35,000. Okay. Additional processing cost. Additional processing cost. If I'm converting L into M, then that will be at an additional processing cost of 1,80,000. And if I'm producing product A, there is a variable manufacturing cost of 12 rupees per unit. So 12 rupees per unit into 7,000. 7,000 into 12, 84,000. Calculate the profit under the two cases, two options. 6,48,000 minus 5,80,000. 5,80,000 is 20. 20 and 48 is 68. 1,19,000. 81 plus 10, 91. This is your profit. So option 2 gives you higher profit. So there is incremental profit of 23,000. 68, 91 minus 68, 23,000. Incremental profit. Correct? So write down. Below the statement, right? Since the profit is more, in option 2, it is better to make it is better to make 7,000 additional units of A, 7,000 additional units of product A as it increases the profit, by rupees 23,000, bracket you write 91 minus 68. Okay, so that is your question number 7.
Sir, one doubt, sir.
Yeah.
Sir, in option 1, we are not selling the material L now, sir. There is a loss of revenue from L, 4 lakhs.
No, but in that case, what you are going to get is you are getting, there is not a loss of revenue, because if L was sold,
It's an
you would have-
opportunity question.
no. If L was sold, then you would have got only 10 rupees per unit. But here you are selling M at 18 rupees per unit.
Okay.
So actually there is a benefit.
Okay, sir.
So if you are not selling L and you are in place of that you are selling M, what is happening is you are having 4,000 units of L could have been sold at 10 rupees per unit, but now we are selling 4,000 units less of M. So we are covering up for more than that by having a higher selling price, 18 rupees per unit. Per unit you are getting 8 rupees more.
Sir, in option 2 also we are not selling L now, sir.
In option 2 we are not selling.
L. We are selling, instead of converting to M, we are selling A.
No. Option 2. Let us read again. Option 2. It is not that we are not selling L. The facilities used to convert L to M. L is already produced. M is not produced. L is already
Instead
produced.
of M, we are producing A, sir.
Instead of M, we are producing A. So L is sold. L is already manufactured.
Okay.
These products J, K, and L are already manufactured. So you have the option of converting L into M, or you have the option of, instead of conversion of L to M, L will be there, keep it as it is, and we produce a new product A. Okay, so L is already
Okay, sir.
produced. Instead of converting that conversion facility is used to produce a new product A. So there is no loss of revenue from L.
Okay, thank you.
Let us come to question number 8. A company has prepared the following budget for the forthcoming year. All figures in lakhs. Sales are given 20 lakhs, direct materials, direct labor, factory overheads made up of two parts, variable and fixed. Variable is 2,20,000, fixed is 2,60,000. Administration overheads are 1,80,000, sales commission given, fixed selling overheads given. Total cost is 18 lakhs. Total profit is 2 lakhs. Policy of the company in fixing the selling price is to charge all the overheads other than the prime cost. Prime cost means direct material, direct labor, and direct expenses, if any. All the overheads other than the prime cost on the basis of percentage of direct wages. All expenses as a percentage of direct wages. And to add a markup of 1/9 of total cost to profit. Okay. While the company is confident of achieving the budget drawn up as above, a new customer approached the company directly for execution of a special order. Material and labor costs for which are estimated as 36 and 64,000 respectively. This special order is in excess of the budgeted sales as envisaged above. That means there will be no loss of revenue as such. The company submitted a quotation of 2 lakh rupees for the special order based on its policy. The new customer is willing to pay a price of 1,50,000 for the special order. The company is hesitant to accept the order below the total cost, as according to the company's management, it will lead to a loss. You are required to state your arguments and advise the management on the acceptance of the special order. Now see, what they have said is, order is in addition to your normal sales. For the special order, the company has quoted a price of 2 lakhs. Price of 2 lakhs, a quotation of 2 lakhs. Now that is not the cost. That is not the cost. That is a price, selling price. So company has said that for the special order, the selling price will be 2 lakhs. Okay. Customer is saying that we will be willing to give only 1,50,000. So now what is your job? Your job is to calculate what is the actual cost for that special order. And if that actual cost is more than 1,50,000, then you cannot accept the special order, because they have said that company is hesitant to accept the order below total cost because it will lead to loss. So if your total cost for the special order is coming to more than 1,50,000, you will not accept that special order. But if your total cost is less than 1,50,000, then you can think of accepting the special order. Okay. So work out and tell me. And for that special order, the materials are 36,000 and labor is 64,000. So calculate the total cost for the special order. Tell me what is the total cost, and see whether if I add, one more thing is there, see whether if I add the profit margin as we normally have, what is the normal profit margin? Markup of 1/9 of total cost to profit. If after adding that, I am in a comfortable position, it is more than 1,50,000 or less than 1,50,000, total cost is more than 1,50,000 or less than 1,50,000. Let us work out all these things and then come to a conclusion whether I should accept the 1,50,000 offer of the customer. Okay, I give you 5 minutes, work it out and see. Tell me, what is the total cost? What is your selling price as per the policy of the company of adding a profit margin of 1/9 of the total cost? So do it and tell me. I give you 5 minutes.
So should I take variable cost on the basis of raw material or
Sir, you are in mute, sir.
సార్ చెప్పేది వినపడుతుందా? నా డౌట్ చెప్తే నా డౌట్
లేదు వినిపించట్లేదు.
ఇందాక నా డౌట్ చెప్పారా?
చెప్పలేదు.
చెప్పలేదు. సార్ మ్యూట్ లో ఉన్నాడు.
అవునా? అంటే ప్రైస్ నుంచి టోటల్ కాస్ట్ కనుక్కోవాలా?
So this
ప్రైస్
is,
ఇచ్చాడు కదా 2 lakhs.
just check the figures. Direct
2 lakhs
wage
into 9/10.
direct wages 64,000. Variable overheads 2,20,000 in the original part, divided by 6,40,000 into 64,000 of the current direct wages. What else is there? No other cost. Fixed overheads will not be taken. So we'll calculate total cost. $90, 1,22,000. Now add the profit to this. As per company policy, profit is equal to 1/9 of total cost. So 1/9 of 1,22,000. $13,556. Selling price as per company's policy. Selling price as per company's policy is 1,35,556. 1,35,556. Now, if you go to see, the customer has offered us 1,50,000. What is the customer offer price? 1,50,000. This is what the customer is offering us. What is my cost over here? My cost is 1,22,000. So if I accept the customer's offer price, still I get a profit of 28,000. And that 28,000 is more than my company's profit as per expected policy. 28,000 is the profit that I'm going to get, which is more than my expected profit of 13,556. So you will advise the management to accept the offer, because the actual profit that is going to be earned at 28,000 is more than the expected profit as per company's policy. Okay, so let us write down. Since the customer is willing to pay, rupees 1,50,000. Rupees 1,50,000 for the special order. Comma. The offer price should be accepted, or you can just write the offer should be accepted. As the profit will be rupees 28,000. That is 1,50,000 minus 122, our cost, which is more than the expected profit. Of rupees 13,556 as per company policy.
So the doubt I asked you earlier, I couldn't hear anything.
What doubt?
Why shouldn't we use direct material for variable overheads?
No, that is given in the question. See, it is given in the question. Policy of the company in fixing selling price is to charge all the overheads other than the prime cost on the basis of percentage of direct wages.
Yeah, other than the prime cost means variable cost comes under prime cost, right? That means we should use the other.
Variable cost is not prime cost. Who told you variable cost is prime cost?
Because it is included in the factory overheads. Factory overheads is prime cost.
Factory overheads is prime cost. Oh my God. Cost sheet you have forgotten.
No.
You have forgotten the format of cost sheet. Factory overheads is not a part of prime cost. Factory overheads comes after prime cost. Prime cost plus factory overheads will give you works cost. Yes or no?
Yeah.
Direct material plus labor plus direct expense
Direct overheads,
is
direct
called as prime
expenses.
cost. Plus factory overheads will give you works cost.
Yeah, sir.
So variable factory overheads is calculated as percentage of direct labor. Okay, point is clear?
Yes.
Fine. Let us come to question number 9. Mr. Karan has taken a shop on lease basis and has made a down payment of 2,50,000. Additionally, the rent under the lease agreement is 96,000 per annum. So that 2,50,000 is a deposit. It's like a fixed cost. Rent is given as 96,000 per annum. That is also a fixed cost. Because when you're talking about down payment, that is going to be refundable or non-refundable, that we don't know. But as of now, we assume that it is non-refundable. It will be adjusted along with the against the rent. That is, lease agreement would have been higher. The rentals would have been higher if there is no down payment. Or we can assume that it will be receivable back at the end of the lease. Either way, it is not going to affect my cost. Then they have said, if the lease agreement is cancelled by Mr. Karan, then the initial payment is likely to be forfeited. So initial payment, that means like 2,50,000. That is actually refundable. So now we come to know that it is refundable. But if it is, the lease is not carried on and it is cancelled in between, then that 2,50,000 is forfeited. It will be a cost for us. Mr. Karan plans to use the shop for general stores business and has estimated operations for the next year. Sales 25 lakhs, less VAT 2 lakh 80. So sales after VAT is 22 lakh 20,000. Less cost of goods sold, wage and wage related cost, rent including down payment, rates, lighting and insurance, audit, legal and general expenses, net profit before tax. In the business, Mr. Karan will be devoting half of his time. However, no provision has been made for his remuneration or salary, like in the case of proprietors. Proprietorship concern, normally proprietor cannot pay salary to himself. He has also an option to sublet the shop to his friend for a monthly rent of 18,000 rupees if he does not use the shop himself. You are required to calculate the most profitable decision which should be taken by Karan on the relevant cost basis. So whatever is not relevant, we will not consider that. So fixed cost, sunk cost, all these things are not to be considered. So calculate and tell me, which is the most profitable decision? To carry on the business himself. Now that net profit that is given to you, 18,000, that is by taking total cost into consideration. But now we are saying on the relevant cost basis. So fixed cost, sunk cost will not be taken. Okay? So calculate and tell me which is the most profitable decision and why. Should he continue the business himself or should he let out the shop to his friend and earn a monthly rent of 18,000? Calculate and tell me. I give you 5 minutes. Anybody with the answer? Yes, Akhil. Akhil has got the answer.
Three lakh 64,000.
3 lakh.
64,000. If it's own business.
Okay. Fine. The profit earned by the business will be 3,64,000. And the revenue that is going to be earned from the rentals is 2,16,000, 18,000 into 12. So obviously the profits of the business are higher than what we would have got as rentals from the friend. So how to solve now? First, what we have to do is we have to write two notes here. One is the down payment made for the lease is a sunk cost. Which cannot be recovered. Even if the lease is cancelled. Second, if Karan uses the shop for his own business, then there will be an opportunity cost of rupees 18,000 per month. That is rupees 2,16,000 per annum. Okay. Now we prepare statement of profit from own business in bracket on relevant cost basis. I start by net sales 22,20,000, that is excluding VAT. What is relevant for me, that only I will take. Less cost of goods sold. Less cost of goods sold. 12,50,000. Wages and wage related cost. Wage related cost. 2,76,000. I will not be taking the rent including down payment because that is a fixed cost. The rent is a fixed cost, down payment is a sunk cost. So that will not be taken. Then I have rates, rates, lighting and insurance. Two lakh 80,000. Audit and legal expenses. $50,000. Profit from business. Three lakh 64,000.
Sir,
Yeah.
what about the annual rent of 96,000?
Annual rent of
96,000.
that is a fixed cost that has to be paid irrespective of whether you are using it for your business or it is going to be let out. So anything which is a fixed cost will not be a relevant cost.
Okay.
Anyway, you have to pay it. So it is not relevant for the decision-making process.
Okay, sir.
But other things like rates, lighting and insurance, audit, legal expenses, all these things are going to be paid by you only if you are having the business. If you are not having the business, if it is to be let out, then those expenses will not be there. So it is a relevant cost. So what is the decision now? Since the profit from own business is more than the opportunity cost of 2,16,000 per annum, it is advisable not to sublet the property. So write down. Since the profit from own business is more than the opportunity cost, it is advisable not to sublet the property. You can write a note here. Rent paid is not a relevant cost. Since it has to be paid. It has to be paid. Whether Karan carries on. Karan carries on his own business or sublets the property. Okay. Now we come to last question, which is an important question. Question number 10. Your market is important. A company has nearly completed a job relating to construction of a special equipment when it discovered that the customer has gone out of business. So you are doing some construction work for a particular client. Halfway through, you find that client has gone bankrupt. So he will not be able to pay you. So now you have to sell that construction to some other person. Okay. So nearly completed a job relating to construction of a special equipment when he discovered that customer has gone out of business. At this stage, the position of the job was as follows. Original cost estimate is 1,75,200. Cost incurred so far is 1,48,500. Cost to be incurred is 29,700. Progress payments already received from original customer, first customer, is 1 lakh. This is the current status of the business. After searching for a new customer for the equipment, a new customer has been found. He is interested to take the equipment, but if certain modifications are carried out. So in the present form, he is not going to take it. He says that modify the equipment, then only I will take it. The new customer wanted the equipment in its original condition, but without its control device and certain other modifications. The cost of these additions and modifications are as follows. Direct materials 1,050. Direct wages, Department A 15 man days, Department B 25 man days. Okay. So starting with the direct materials, all these things are given to you as the additional cost. Now, variable overheads are given as 25% of direct wages in each department. Delivery cost is 1,350. Fixed overheads are given, which are absorbed at 50% of direct wages in each department. Following additional information is available. The direct materials that you require for the modification, they are already in stock. And if not used for modification of this order, they can be used in another job in place of materials that will now cost 2,250. So they have given direct materials over here as 1,050. Then they are saying that this is already in stock and you are given the relevant cost of that is 2,250. So you have to take 2,250 as the relevant cost over here, not 1,050. Okay. So Department A is normally working and hence any engagement of labor will have to be paid at direct wage rate of 120 rupees per man day. Department B is extremely busy. Extremely busy. That means there is no spare capacity. Extremely busy. No spare capacity. Its direct wage rate is 100 rupees per man day and it is currently yielding a contribution of 3.20 per rupee of direct wages. So if you are going to utilize the labor of Department B, normal wages plus the opportunity cost, that is loss of contribution, will have to be considered. Supervisory time, overtime payable for the modification is 1,050. Cost of the control device the customer does not require is 13,500. Does not require 13,500. If it is taken out, it can be used in another job in place of a different mechanism. The latter mechanism has otherwise to be bought for 10,500. The dismantling and removal of the control mechanism will take 1 man day in Department A, which means that you will be having 120 rupees to be paid per day. Okay? Then they have said, if the conversion is not carried out, some of the materials in the original equipment can be used in another contract in place of materials that would have cost 10,000 rupees, 12,000 rupees. It would have taken 2 man days of work in Department A to make them suitable for this purpose. The remaining materials will realize is 11,400 as scrap. Drawings which are included as part of the job can be sold for 1,500. calculate the minimum price which the company can afford to quote for the new customer as stated above. Okay. So first thing that I want to ask you, what is going to be the effect of all these things? Will there be any effect of all these things? Original cost estimate, is it relevant cost or irrelevant cost? What is it? Yes, Praveen?
Cost to be incurred is relevant cost.
No, I'm asking about original cost estimate. Is it relevant or irrelevant?
Not relevant, sir.
Not relevant. Cost incurred so far, 1,48,500.
Not relevant.
Not relevant. Cost to be incurred, 29,700. Is that relevant?
Relevant, sir.
It is relevant. What about progress payments received from the original customer 1 lakh? Relevant? Relevant means what? Apply the criteria. Na? Relevant means future. Is it future cash flow? It is a past
Already
cash.
received.
Yeah,
Already received.
You don't have to think much. If it is a future cash flow, then it will be a relevant cash flow. Otherwise, it's an irrelevant cash flow. So progress payments received 1 lakh is not to be considered. So only this will come out of that. 29,007. Okay. So let us start. First, we'll write a small note and then we'll start with the statement. Write down. The original cost estimate. The original cost estimate. The expenditure already incurred. The expenditure already incurred. Comma. The progress payments already received. The progress payments already received from original customer and the cost of control device already incurred. The cost of control device already incurred are all irrelevant. Are all irrelevant. So they have said, now the new customer wanted the equipment in original condition, but without its control device. So that means the control device expenditure that we have already incurred, that is irrelevant for me. That is of no use to me. Okay. So now let us start with the statement now. Statement showing relevant cost. Statement showing relevant cost. Let us go in order. Out of the first 4 figures given to us, only the cost to be incurred is to be considered, 29,700. Cost to be incurred. 29,700. Then coming down to direct materials, 1,050. Direct materials are already in stock. So I will take the materials which are there in stock, but replacement cost of that is 2,250. So second I will take direct materials. Replacement cost. $2,250. Direct wages. Department A. 15 man days. 15 man days at 120 rupees per man day. So 15 into 120. 1,800. For Department B, Department B, 25 man days and wage rate is 100 rupees per man day. So 25 into 100, 2,500. Variable overheads. %25 of direct wages in each department. %25 of 1,800 plus 2,500. 3,000, 4,300 into 25%. 1,075. Now, come to adjustment 2 and 3. Adjustment 2 says that Department A is working normally and hence any engagement of labor will have to be paid at direct wage rate. Fine. But Department B is saying that all our laborers are extremely busy. We don't have spare labor. And if you are taking my labor, then there will be a loss of contribution. That is at the rate of 3.20 per rupee of direct wages. So let us calculate this. Loss of contribution of Department B. Loss of contribution. Department B. 3.20 per rupee of direct wages. So 3.20 into direct wages of Department B is 2,500. 8,000 rupees. Delivery cost 1,350. Fixed overheads will not come. Because it's allocation, absorption. Come down to adjustment 4. Supervisory overtime payable for modification, 1,050. Can call it a supervision cost. $1,050. Okay. Now come to adjustment 5. And tell me how it is to be taken. What amount is to be taken? Adjustment 5 says, let's come to the adjustment 5. Cost of control device that the new customer does not require is 13,500. That we are not considering. It is gone, irrelevant cost. If it is taken out from that equipment, it can be used in another job in place of a different mechanism, which has otherwise to be purchased for 10,500. Dismantling and removal of the control mechanism will take 1 man day in department A. So now tell me, what will be the amount that we are going to show and as what we are going to show? How are we going to show this amount? What is the amount that we are going to show?
3,120.
3,000?
120.
How 3,120? See, understand what they are saying. They are saying that there is a control device now that is there in my equipment now. It is no longer required. Now, whatever has been spent on that, that is irrelevant. 13,500 is irrelevant. But now that I will use for another mechanism instead of another mechanism. So it will result in savings in cost to the extent of 10,500. Correct? It will result in savings in cost of 10,500. Because I don't have to purchase that other equipment. I will be using this control device over there. So there is a savings in cost of 10,500. What else is there? What else is there? Will that be my total savings in cost 10,500? No, because this 10,500 is my savings in cost. Now, cost of dismantling and removal of the control mechanism will take 1 man day in department A. So from that savings in cost, I will minus the labor cost of department A, and department A labor cost is 120 plus. But that is not all, because variable overheads are dependent on wages. So what will be my total savings in cost? 10,500. 10,500. Minus from that the labor cost of 120 per man day. Minus from that 25% of 120, which will be my variable overheads. So my net savings in cost will be after deducting all these figures. So let us come to the statement again. Savings in cost. Savings in cost from control device. $10,500 minus 120 minus 25% of 120. 30 rupees. So 150 you have to minus. 10,500 minus 150. It's 10,350. It's a benefit. It is not a cost. So put it in bracket. All other things are cost. Okay. What next? Adjustment number 6. If the conversion is not carried out, some of the materials in the original equipment can be used. If the conversion is not carried out, but we are carrying out the conversion. If it is not carried out, then what will happen? Some of the materials in the original equipment can be used in another contract in place of materials that would have cost 12,000. So there is an opportunity cost. There is an opportunity cost. That since I'm doing the conversion, I cannot utilize these materials in another job which would have cost 12,000. And it would have taken 2 man days of work in department A. So 2 into 120, 240. Minus 25% variable cost, variable overheads. Okay. So now I call this as opportunity cost. Opportunity cost of materials on conversion how much? 10,500. Sorry. 12,000. 12,000 minus 2 days, 2 man days of department A. So 120 into 2, 240. Minus 25% of 240. Variable overheads. So calculate. $11,700. Had the conversion not taken place, the remaining materials would have sold as scrap for 11,400. So loss of cash inflow. Scrap value of remaining materials. And write in bracket here, opportunity cost. 11,400. And the drawings which were there could have been sold at 1,500. So now that also I'm not going to recover. Sale of drawings. Again, opportunity cost. 1,500. Tell me what is the net figure. Remember that one figure of 10,350 out of minus. Are you getting 61,975?
Yes, sir.
Yes, sir.
Yes.
Yes. So that is a minimum price which the company can afford to quote for the new customer. Minimum price. To be quoted. Okay. So as we have decided, tomorrow we'll have two sessions. One in the morning, 10 to 12, and the second in the evening, as usual, 6:30 to 8:30, which will be on marginal costing. So we have finished with the relevant costing. We'll be starting with marginal costing. Okay. So we'll stop here for today. Good night. See you tomorrow morning.
Sir, one second.
Okay. Thank you, sir.
Yeah.
Sir,
Yes.
sir, it is a minimum price to customer. That means 61,975, right, sir?
Yeah.
If customer asks for any discount, like
Discount cannot be given. Minimum price means
it is a minimum price,
cost to
fixed.
cost. So
Okay.
minimum price is the cost to cost price that I'm talking about, which I can afford to without suffering a loss. Now I can add a profit margin to this and can quote a higher
Okay.
price. But a minimum I should
Okay.
be able to quote this price because this is what I've incurred as my expenditure, as my relevant cost. Okay? Yeah.
Thanks.
So good night. See you tomorrow morning.
Thank you.
Thank you,
Good
sir.
night.